Whether you're in your 30s, 40s, or 50s, retirement planning is an important part of your overall tax plan, and you should certainly consult with your tax advisor to make sure that it's ongoing and up to date. When we advise clients on retirement planning, we want to look at the whole picture and oftentimes what their entire income looks like. There are lots of different retirement plans out there. Most commonly, we advise clients on a 401k, simplified employee pension plan, a Roth IRA, or a traditional IRA. A 401k is an employer-sponsored plan, and the IRS sets different limits for that plan from year to year. An employee will make a before-tax contribution into a 401k plan, and at retirement, usually over age 50 and a half, they will take a distribution. Those distributions are taxable because the money was put in before tax. A simplified employee pension plan is commonly used for self-employed people, so usually a sole proprietor or a partnership. And the contributions are based on the net income of that sole proprietor or partner. So you can usually contribute a much higher percentage being self-employed to a SEP than you could as an employee to a 401k plan. Very much like a 401k, the SEPs are taxable when you take distributions at age 59 and a half or in retirement. Many clients ask about the differences between a Roth IRA and a traditional IRA. With a Roth IRA, you're using after-tax dollars to make contributions year after year, and the earnings on those contributions grow tax-free. When you take a distribution at age 59 and a half, or when you're required to, those distributions are then tax-free because the money was initially contributed with after-tax dollars. A traditional IRA is a little different. You're making contributions with before-tax dollars. So you make those contributions year after year, the earnings grow within the account, but because you have made those contributions with before-tax dollars, when you take a distribution at age 59 and a half, or at retirement, those distributions are then taxable. So oftentimes we advise our clients to look at the other income that they have in that particular year that they're taking a distribution, and we'll often do some tax planning in order to determine what their tax effect will be. So there are lots of different ways that you can prepare for retirement. One idea that we often bring to our clients is, have they taken any sort of distributions from their 401ks, IRAs, or SEPs in the past? Typically they have not, and oftentimes these distributions are taxable to them. So we have to look at what their other income is for the given year and see if those distributions will impact their tax rate going forward. So we oftentimes will prepare projections, determine the amounts that can be distributed, and advise our clients from there. Oftentimes we look at rolling a 401k into an IRA. This is something that commonly has to be done because employers will not allow the employee to keep the retirement plan as a 401k. So there are specific rules that the IRS has put into place as far as how long you have to roll it over once you take the distribution out, trustee to trustee transfers. So this is a topic that we advise our clients to seek professional advice on and make sure that the rollover is done timely and appropriately. Oftentimes we look at stock option planning when someone is retiring. Employees or individuals will have options that are vested with their companies, and we look at the acceleration of those options that are being vested when they retire. We will do projections and planning for them so that we can determine the amount of income that's being accelerated into their return. We want to look at maybe the possibility of deferring income in other areas so that they can maximize their income but also minimize the tax effect.